In the last video, we answered one of the biggest questions new investors have: what should I buy? Today we're going to answer the second question: how much of each investment should I own? This decision is called asset allocation, and research has consistently shown that it is one of the most important decisions an investor will make. Today we'll use history, not opinions, to understand why. We've already chosen three broad categories of investments: US stocks, international stocks, bonds. Now we need to decide how much money belongs in each. This is called asset allocation. Think of it as a recipe. The ingredients matter, but so do the proportions. Two investors can buy exactly the same ETFs and end up with portfolios that behave very differently. For example, Investor A, 90% US stocks, 10% bonds; Investor B, 40% US stocks, 20% international stocks, 40% bonds. Neither portfolio is correct. They simply have different objectives. Every investment portfolio is trying to balance two competing goals: higher expected returns, lower volatility. Historically, portfolios with more stocks have produced higher long-term returns, but they also experience larger declines during market crashes. Adding bonds generally reduces those declines, while also reducing expected long-term returns somewhat. The objective isn't to eliminate risk. The objective is to choose an amount of risk you can comfortably live with for decades. Let's look at history. During the dot-com crash, US stocks fell by roughly 50%. Recovery took around 7 years. During the global financial crisis, markets declined by more than 50% again. Recovery took several years. In 2020, markets fell rapidly during the COVID pandemic, but recovered in only a few months. The important lesson isn't trying to predict the next crash. It's understanding that market declines are a normal part of long-term investing. They have happened repeatedly, and every time, they felt like the end of the world while they were happening. Now imagine two investors. One plans to retire next year, the other plans to retire in 30 years. Should they own the same portfolio? Probably not. Someone with decades ahead can usually tolerate temporary market declines because there is time for recovery. Someone approaching retirement may prefer greater stability. Risk is not simply about age, it's about when you'll need the money. Let's make this practical. I compared three example portfolios using Portfolio Visualizer. Portfolio 1, 90% VTI, 10% BND. Portfolio 2, 60% VTI, 20% VXUS, 20% BND. Portfolio 3, 40% VTI, 20% VXUS, 40% BND. First, look only at the growth curves. Notice something interesting. All three portfolios grew substantially over time, but they didn't grow in exactly the same way. Now let's look at the performance summary. Portfolio 1 achieved the highest return, but it also experienced the greatest volatility. Portfolio 3 produced a smoother ride, although with lower returns. Portfolio 2 balanced both characteristics. This is exactly what asset allocation is designed to accomplish. Changing only the percentages changed the behavior of the portfolio. The investments themselves stayed almost the same. Which portfolio is best? This is one of the most common questions in investing. The answer is, there isn't one. The best portfolio isn't necessarily the one with the highest historical return. It's the one you'll continue investing in when markets fall. Because abandoning a good portfolio during a bear market is often much more damaging than choosing a slightly less aggressive allocation from the beginning. Consistency beats perfection. One final point. Many people think about their retirement account, their brokerage account, and their savings account as completely separate. Instead, try thinking of them as one financial system. Your emergency fund provides stability. Your retirement account builds long-term wealth. Your brokerage account gives you additional flexibility once your tax-advantaged accounts are fully funded. Together, they make up your financial life. Evidence Corner. Today's paper comes from AQR and discusses international diversification. One of the key conclusions is that diversifying internationally is not about predicting which country will perform best. It's about reducing concentration risk. Different economies do not move in exactly the same way or at exactly the same time. Over long investment horizons, global diversification can therefore improve the resilience of a portfolio rather than depending entirely on the future performance of a single country's market. Conclusion. Today's lesson is simple. Choosing good investments is only half the process. Choosing the right proportions is equally important. Your assignment this week is one of two things. If you already have investments, write down your current asset allocation. How much do you currently have in US stocks, international stocks, bonds, cash? Then ask yourself, does this still reflect my goals and time horizon? If you haven't started investing yet, design your first portfolio on paper. Don't worry about making it perfect. Simply decide how you think you would like to divide your investments among stocks, international stocks, and bonds. Your first portfolio won't be your last. Investors refine their portfolios throughout their lives as their careers, families, and goals evolve. The important thing is to begin with a thoughtful plan rather than chasing the latest trend. In the next video, we'll learn how portfolios naturally drift over time, why that happens, and how to rebalance them while keeping unnecessary costs and taxes to a minimum. Remember, understand the foundations. Build a simple structure. Let time do the heavy lifting.